Okay. Hi, everyone. Thank you for joining us for today's webinar on SEC comment letter trends. If you're attending the webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, you'll receive an email within 3 business days with access to your certificate of completion. So really quickly before we begin, I'd like to go through a couple of housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. You'll see a chat box that you can use to enter the questions. Just type in your questions and click submit. If we have time during the webinar, we'll answer them. If not, we'll definitely address them after. Second, to ensure good audio quality, please check your settings. If you're using a telephone, please click on the Use Telephone Audio mode. If you're listening through your computer, then please click on the Use Mic and Speakers. Now a quick review of our CE requirements. To qualify for California CE, you must do all of the following. Use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. We'll have 4, which means you need to respond to 3, and you must complete the evaluation survey at the end of the webinar. Now for a quick introduction to our speakers. First, we have Matt Peralt. He is an audit partner and head of our SEC and technology practice. He has more than 25 years of experience supporting more than 30 technology sectors transitions. He's participated in numerous IPOs and M&As, and he's been involved in private placements and LBOs, both in industry as an auditor. He served in the technology practice at Ernst & Young. He's also served as a controller and VP of finance at various companies. Next is John Dunnican, partner with our CFO Advisory Services. He has more than 30 years of financial executive, operations, and consulting experience in both the public and private sectors. He's also held positions as a CFO, VP of Finance and Administration, Treasurer, Controller, and Director of Operations. His background includes extensive management, financial, and operations skills, including technology, manufacturing, publishing, service and distribution, and banking industries. And with that, a quick review of our learning objectives. During today's webinar, we will identify the organizational structure of the SEC, review the top comment areas, and analyze some comment letters. And I'll turn it over to Matt for a little bit more detail.
Thanks, Deb. As you said, we will run through the structure of the organization of the SEC, and then we'll dive into some specific comment areas. And this year, although we took a look at all the comment areas, we decided intentionally not to repeat those areas that were of significant comment, but that we had covered last year. So we'll run through MD&A, internal controls, statement of cash flows, business combination, and income taxes. So let's take a look at the SEC organization structure. And first we'll start with, this slide really lays out the mission of the SEC, and that's to ensure the protection of its investors by ensuring information is adequately disclosed and consistently displayed among issuers. And that's really the reason for SEC review of documents that are filed with them. The SEC is organized into these 5 divisions: corp finance, enforcement, risk strategy, investment, and then trading markets. Corp finance is the organization within the SEC, or the department that actually conducts the SEC reviews, and more than 80% of the personnel within corp fin are responsible for, or at least some point during the year, have duties that encompass SEC review. This is the organizational structure of the SEC. Mary Jo White got nominated and elected in 2013. And you'll see the rest of the commissioners in the organization.
Thanks, Matt. And we'll start with a quick polling question before we get into the good stuff here. So first question is going to be a true or false. So does the SEC typically only examine documents filed with them? A, true, B, false, or C, not sure? And as a reminder for those before we begin that we will be sending around a copy of these slides after the presentation, so you'll be able to review them after the presentation. And we'll close the polls here in 3, 2, and 1. And it looks like 62% said false, 31% true. John?
Sure. So for those of you that said false, you are correct. One of the things, we'll talk about this quite a bit today, is that the SEC does look at documents beyond what is filed with them. They will very definitely will look at your website. They will listen in on your press conferences and your analyst calls. They will look at articles that you've published or have been written by senior management. Because one of the things they're very concerned about is to ensure that the documents that you file with the SEC and documents filed with the SEC are consistent with what you're saying in the public markets. So they will absolutely look at everything that the company publishes or puts out there and compare that to the documents filed for consistency. You'll see some of that in some of the comments we talk about today. So talking about the review process, clearly there are two real goals of the review process: to increase transparency, but they also want to make sure that they're very, very clear about their willingness to discuss issues with the registrants. In 2009, the SEC staff issued an overview, which really consisted of two sections. One has to do with the filing review process, and a corporate division. The SEC is divided into 12 offices with experts in each of the 12 offices based on industry specialization. So they review the filings. So that's how the process works, and you will get letters from the SEC if they have questions. And of course, you want to respond to those as quickly as possible. There's also in the summary the reconsideration process. The SEC is very willing to discuss comments with the company, with the lawyers, with the accountants, with interested parties within the company. So if you do get letters and you have questions, they absolutely will discuss those and reconsider the questions and whether or not your disclosures are adequate. And sometimes they will withdraw their letter or their comments. Over the last couple of years, the number of comment letters have actually gone down fairly substantially, as you can see here on this slide. They've gone down from about almost 14,000 in 2010, down to about 6,300 in 2014. Interestingly, particularly for most of the folks on this call, I suspect, the number of comments related to technology companies actually increased fairly substantially. In 2012, it was about 1,600. In 2014, it increased almost 2,500. So clearly the technology industry is getting a lot more scrutiny. It's about an 18% increase, and which is not terribly surprising, because as the technology industry once again is getting a lot more attention. It's one of the hot sections of the economy. There's a lot going on with the stock prices, so it's definitely an area that's attracting attention. So over the last couple of years, the technology has increased, although the overall has continued to decrease. As you can see here, it is a really busy slide. But the most interesting thing, of course, is the top 5 or 6 items have really remained unchanged in terms of the frequency of comments. MD&A continues to be number 1, has been for a number of years. Fair value, revenue kind of make out the other big 2. The one that's really increased and kind of moved up in the list is kind of about halfway down: mergers, acquisitions, and business combinations. Been a lot more comments on that. Obviously not surprising given what's going on in the economy and the market. There've been a lot of acquisitions, a lot of activity in that area, so you would expect to see a lot more comments in that area.
Okay. This is just some information on specific to S1 filings. The average comments in a typical comment letter in the last year has been 16, again, with similar areas that John just spoke about in terms of the top areas of comment: MD&A, stock-based comp, revenue recognition, and internal controls. And for those of you that have been through a S1 filing process in the SEC review, that is certainly an area that receives a great deal of time, effort, and attention from the company, not just because it's the first time they're exposing their financial statements to public eyes, but certainly because the timing of that offering is typically something that has been planned well in advance, and they want to make sure we get through the SEC review process in a quick and efficient manner. So hopefully some of the information we provide you today will allow those of you on the line contemplating an S1 or an IPO in the future to get through that process more quickly. Again, here's a breakout of those specific comment areas by ranking. So you can see again, the information outside of the F pages typically does receive the greatest amount of comments. I know when I'm involved in an S1, the first thing we look at is where were the comments on the F pages in the MD&A, because as an auditor, that's where I'm typically involved in. You'll see company description as the #1 area. Often, as John said, the SEC is going to look well beyond what is contained in the company's filing to identify any inconsistencies or discrepancies they see, and certainly in company description, there's often quite a bit about the industry, and there'll be quite a few statements about the company and just their position relative to the industry and the market. And so the SEC is often looking for information that validates any claims that the company makes relative to their position in the industry. And this year, well, actually in 2014 is the data that we have through. You can see that 18% of IPOs reported profits under non-GAAP, which was the largest since 2009. Typically in an S1 and certainly in press releases, probably more commonly, a company is going to express their financial results on a non-GAAP basis. And the important things to consider when a company is disclosing non-GAAP measures certainly is the prominence of those. The SEC rules read such that you do not want to give greater prominence to non-GAAP measures. You want to provide investors information as to why you are presenting them the non-GAAP measure. Is that something you think is important to the investor? If so, why? Is it a metric that the company uses internally to measure their performance? And then you got to make sure that if you're disclosing a number, you are performing a table, creating a table in the financial statements or in the S1 that reconciles the GAAP number to the non-GAAP number, so that you're clearly spelling out what are the reconciling items between that. So those are certainly areas the SEC is going to be focused on if you elect to include non-GAAP numbers such as EBITDA or similar numbers in your S1.
Thanks, Matt. So we'll get to our second polling question. Question is, what is the most common MD&A issue from the 2014 comment letters? Now think back to that very busy slide that John talked about just a few minutes ago. Is the answer A, liquidity, B, critical accounting policies and estimates, C, results of operations, D, none of the above, or E, not sure? And again, if you're attending the webinar for CE credits, you'll need to respond to at least 3 of the 4 polling questions we'll be asking, and this is the second one. We'll get your answers in and close the polls in 3, 2, and 1. Pretty mixed bag here, but it looks like 33% said results of operations. John, maybe you want to talk about that for a second.
Sure. We'll talk about this again in a moment here, but yeah, the results of operations is the #1 comment area with the SEC within MD&A. It is probably, we'll see, because it's an area where management has a lot of flexibility in what they say, how they address things, the issues they address. As Matt talked about, you see a lot of the non-GAAP issues come up in the results of operations. So that's the area they really focus on the next, followed by liquidity, capital resources, and then some of the non-GAAP specific issues. So results of operations is #1, and so for those of you that answered appropriately, so we're going to look a little bit for some of the technology comment letter areas, and these are the areas that Matt talked about earlier. We're going to kind of focus on. We're going to talk about the MD&A, some internal controls, cash flows, spend a little bit of time on business combinations, and then income taxes. So since the MD&A is the #1 area of focus for the SEC in terms of comment letters, we want to kind of start there. The purpose of the MD&A is really to enable investors to see the company through the eyes of management, to really offer context to the results of the financial statements. It really kind of allows investors to assess the likelihood that the results are going to continue in the future, and really understand the risks of towards future performance. The objectives of the MD&A really, as I said kind of before, is really transparency, providing relevant information. It's really tailoring the company's results and the company's facts and circumstances to what's going on in the economy, to really be consistent with the financial statements and other public communications. As we mentioned earlier, the SEC will definitely be looking at your website, your press releases, speeches made by your executives, and they're going to really kind of make sure that that information, to the extent they can, is all very consistent through the MD&A, and really kind of be comprehensive in addressing the business risks that you talk about in your risk section. So it's really not looking for you to simply repeat the information that's in the financial statements, but really kind of provide explanation, really kind of help them understand the business as management really looks at the business and understands that. Here's actually the chart of the top areas of breakdown by common area. As you can see, the results of operations has increased, liquidity and capital and the others have kind of decreased a little bit. Continued heavy focus on the results of operations over the last 3 years. And I think that's probably going to continue into the future, as there's a lot more pressure on management to really explain what's going on in plain English, so the investors really can understand the business and how it's operating. Here's one particular comment that we can talk about, because this is typical of what you're seeing a lot more as we talk about the consistency of information has been a big area of focus. They're really focused on management's understanding and discussing the business trends on earnings calls, social media, the website and whatnot, really making sure that information is consistent. So it's imperative on management really to make sure, and when the folks on this call are really preparing the MD&A, to understand what's going on, what's being said, and really make sure you address those issues in the MD&A, because you can expect the SEC to come back with comments if you do not.
So this slide really takes a hard look at internal controls, and you can see that the volume of comments has tripled in 2014 in comparison to the prior two periods. Certainly the SEC, and we feel this even as the audit firm, the PCAOB, when they are coming in, they are taking a much greater emphasis on internal controls, and as it relates to the companies, the disclosures that those companies are making in their publicly filed documents. And as those of you who are on the call are aware, certainly even on a quarterly basis, companies are responsible for disclosing whether or not their disclosure controls are working. And part of that disclosure is both the CEO and the CFO have to sign a certification saying that they've looked at the system of internal controls on a quarterly basis, and they're comparing that against their last annual evaluation and making sure that there are appropriate controls in place so that they know if there's been any changes and that they can disclose those changes on a quarterly basis. And then as it relates specifically to S1s or IPOs, you can see that 40% of all technology companies that filed an S1 in the last year did report a weakness over internal controls. So certainly that begs the question then, what are the ramifications of that identified weakness in internal control, and has management properly considered the ramifications and then cascaded those in appropriate disclosure throughout the rest of the document? So again, this slide really touches on the company's requirements around internal controls, and on a quarterly basis, have you had any changes in internal controls? Certainly one of the things to take a look at is any acquisitions that have been made, any significant changes in the IT environment. And I went through this process with one of our public companies, and the SEC had actually looked at their press release, and not even that, but to the transcript of a conference call, and identified that the company was putting in a new ERP system. And then they asked specifically for the progress of that ERP system and how that impacted their quarterly certification of internal controls. So here's a specific comment from the SEC, and again, this is focused on the quarterly evaluation. In this case, they're saying as of December 31st, 2012, the company identified a material weakness and disclose that in the financial statements. But then in the next quarter following that annual certification, they said disclosure controls and procedures are effective, but in fact that there was no changes in internal control over financial reporting during that first quarter. So certainly the SEC caught this and said that begs the question, how could you have had no changes in internal control? 3 months ago you're saying that they were ineffective, now you're saying that your disclosure policies are effective. So I imagine in this circumstance the company certainly had to amend that filing to come back and state either that there were changes in internal control that were bolstered and fixed so that that material weakness was eliminated, or in fact that that material weakness continued to exist. And typically when you're getting a material weakness at the end of a given year, if it's controls that are functioning on a quarterly basis, then by that first quarter you are not going to have had a large enough time to both identify those weaknesses, remediate them, and then test the controls with enough population to assert that they have suddenly gone from not working to working. So that's typically the fact pattern that we see. And then another area of emphasis for the SEC is, as we talked about, is really just disclosing the effect that any identified changes in internal control have on the rest of the business. One of the things you're seeing in the business section of the document, and the risk factor certainly, is what is the potential impact of that material weakness? What is that going to do to investor confidence? What does that do to the company's ability to raise capital? And how does that impact the company's ability to report on a timely basis? And certainly the SEC in many cases is saying, hey, we need you to more fully disclose to your investors the risk that results from having that material weakness. And here's a specific example of that. So an SEC comment that says, in light of the disclosure that you've provided in your quarterly reports, you should be alerting your investors to additional risks that result from those circumstances of material weakness. So again, they're asking for enhanced disclosure. And typically the way a company would respond to this is not necessarily by amending those past 10Q filings with the SEC, but they would say, all right, we recognize, in the response letter you would say, we recognize your concern. We have developed this risk language that we will put into future filings. And typically the back and forth with the SEC, most commonly I'd say, is that companies are making changes on a prospective basis, and typically amending a filing is not necessarily an item that's done on a frequent basis. I'd say probably less than 10% of the circumstances have I seen a company amend a filing in response to an SEC, unless it's in the S1. Obviously, then you're going through, continual amendment process.
Thanks, Matt. So third polling question, and that is a true-false question. The volume of comments related to internal controls for technology companies doubled from 2012 to 2014. Is that a true statement? A, B, false, or C, not sure? Pay careful attention to the word doubled. And again, if you all would like copies of these slides, I'll be emailing them out to you after the presentation, so no worries there. We'll close the polls here. Get your answers in 3, 2, and 1. And it looks like, Matt, I'll give this back to you, but 65% said true.
So the actual answer is false. It actually tripled during the period from 2012 to 2014. So again, just something to be aware of. Make sure you're taking a look at your quarterly and annual internal controls assessment, and then if there's any changes to that evaluation, that you're making sure to appropriately disclose those both in the certification statement as well as the rest of the document.
So next we want to spend a few minutes talking about another area, cash flow, which is an area that the SEC is focusing a little more on than they have, I think, in the past. I think as probably everyone on the call knows, within a cash flow statement, there's generally three major classifications. There's operating, investing, and financing. And the SEC is going to really look at whether or not the items within those categories make sense, and does the explanation around those make consistent with everything else, and do they really explain what's happening within the cash flow statement, and how does that impact the long-term liquidity of the company, the ability of the company to finance itself, and whether or not there's going to be any potential liquidity problems in the future. One of the questions that often comes up is, should transactions be shown net or gross? The SEC's preference generally is that the classification of transactions be shown, or the description of transactions be shown gross. The feeling is that it provides a much better explanation as to what's going on, the nature of the transaction, and the potential impact it'll have on the company. For items that are short term, which is generally 3 months or less, it's the presentation is net. So clearly, all of your current assets and liabilities, your typical changes in accounts receivable, accounts payable type expenses, those are of course shown. Those are just shown net changes. The focus here is not so much on the operating; it's really kind of on the investing and financing areas, where there's a lot more emphasis on showing the information gross. And then part of that is also how does that get explained in the MD&A, in the liquidity section of the financing. And it's not simply a kind of a recitation of accounts receivable went up because of increase in sales kind of thing, but they really want to understand what's going on, what's really driving the transactions, what are the underlying business issues, business trends that are going on, how is the economy going to impact what's happening. Maybe a relevant question right now is all the rapid changes in the stock market. How is that going to impact the liquidity of the company and the company's ability to finance itself? If the company's looking to do a follow-on offering, right now that could be very difficult. With the stock market being the way it is, so what are the company's plans to work around that if that's a relevant issue? So they do very much want you to explain what's happening right now and what the short-term impact of that could potentially be and the long-term impact with a broader eye of not just the company but the economy, competitors, or world market, and possibly even geopolitical kinds of issues that are going on if that's relevant to your company. For international companies operating in the international stage, those could have very, very significant impacts on the ability of the company to do investment and financing, investing in operations, and its ability to finance the business can be really impacted by those types of things. Here's a potential comment you might see in one particular company where purchase of property and equipment was shown net. And the SEC is coming back and saying, explain why this presentation is consistent with the requirements of the ASCs in the cash flow statement. And I guess as the comment goes on, is really to understand how that impacts the business and what are the net investments. Presumably the company has done purchases and sales, retired assets, and really kind of understand. The SEC really wants that broken out so they can understand how the business is operating and what the potential impacts of the company is on those activities. This is purchases of property and equipment, but the same is true when you refinance debt, use a stock offering to pay off debt, refinance leases, any of those types of activities where you have both ins and outs, payment down of debt. They really want to understand those growth. So we really are looking to see that more, not just on the face of the cash flow, but then within the explanations of the liquidity section of the MD&A and the registration and the filing, whatever it might be.
Yeah, I think most commonly when I read through 10Ks and look at the liquidity section, it really is a mechanical reciting of the statement of cash flows. And what's interesting is my experience has been that the SEC has not typically commented on that. I don't know, John, has that been your experience as well?
That has been, and it's the SEC is really pushing back on that, because that has been the way people have tended to do it. They've kind of done this, quick recitation of what happened kind of on the face of the cash flow statement. Yeah, saying receivables went up, payables went down. And the SEC is now really beginning to focus on that. And I think the advice we've often gotten from attorneys, quite honestly, is to say less rather than more. But the SEC is really kind of pushing back on that. They are really looking for a lot more detail than a lot of times management is comfortable giving, because management a lot of times wants to be a little bit, a little higher level, a little more summary. But the SEC is really kind of pushing back on that to really get companies to disclose what's actually happening, despite the fact that management might be a little worried about doing that.
And I think another thing for the folks on the line to be aware of is certainly the depth of SEC review is going to vary based on their, how many S1 filings are in the pipeline right now, because the SEC has a limited amount of resources within the Corp Fin organization. So if they're all spending their time reviewing S1s, certainly in 2014 and the first half of 2015, we saw a large volume of that. So probably the depth of their review of the regular filings, the 10Ks and the 10Qs, is not going to be as exhaustive. And that's why I think, again, my experience has been the S1, they're tending to take a deeper dive into the business section of the document and really challenging things, whereas in the review of the Ks and Qs, it's more of an orientation towards let's enhance the disclosure as opposed to let's change the disclosure. So just something to be aware of.
Yeah, and I think along the same lines is that also is going to be driven by the changes in the economy. As I said, the recent stock market activity may have the SEC looking at some things more closely than they might have, even 2 months ago, because that's going to propose some challenges to certain companies. And if the SEC feels that the particular industry or company type is going to be impacted by those types of activities, that's definitely going to drive their review, because they are very sensitive to what's happening in the economy and in the markets, and will change their focus based on that. So where an industry before might not have gotten a lot of scrutiny, when things happen in the economy, the scrutiny will change and the focus will change, and the industry focus will change.
Yeah. So another comment we had promised you folks we're going to focus on is business combinations. And certainly we've seen in the tech space that there's been quite a number of acquisitions over the last couple of years. And with those acquisitions comes some complex accounting and disclosure issues for those deals that are undertaken. So as we jump to the next slide, got a graph here that shows the merger and acquisition activity within the specific software industry, and you can see 2014 really was a banner year for acquisitions, and just total number of deals as well as the absolute dollar amount of those deals was very significant in 2014, and it's tapering off quite a bit here in 15. But you can anticipate, certainly if you're involved in an acquisition, the SEC is going to really focus on that as part of the review process. So here's an example of another comment where the SEC is effectively saying, we noticed that 60% of your purchase price was allocated to goodwill, and we want you to further explain and disclose the assumptions in using that. And this comment goes on to ask the issuer to identify whether or not they engaged a third party to take a look at the valuation here. And certainly my experience has been companies that make an acquisition of any significance typically are going out and getting a third party to do the valuation for that. Most companies don't have the expertise to handle something like this, and they recognize this is sort of a significant judgmental area that's going to impact accounting. Certainly the SEC comment in this respect, I imagine, was focused on the fact that a big part of that purchase price is being allocated to goodwill, which is not an amortizable intangible asset. And so, I'm certain the question that they're asking behind the scenes is, well, it's interesting that you did not put much of that purchase price towards the other identified intangibles that would have resulted in an asset that would have to have been expensed over some period of time. So
yeah, very large percentage of the purchase price going to goodwill definitely seems to be increasing a red flag for the SEC.
Yeah.
They really kind of question whether or not the company protecting with an eye protecting investors, for 60% of its goodwill, I think they're really kind of questioning whether or not the company might have overpaid for the asset, for the company, rather. So I think they're really just kind of challenging those assumptions to make sure the management has a good basis for what they're doing. So it definitely seems to be a red flag if you have a lot of goodwill coming out of a transaction.
Yeah. Hey, what's interesting is we went through an S1 process right now with one of my clients, and the SEC did ask for greater disclosure, transparency around how they were valuing IP in this circumstance, and we added it into the document. I don't know that at the end of the day, the enhanced disclosure really gave the investor much additional information. It just described the two methods that were used. I think in the eyes of the SEC, maybe validating that a third party was used, that there were, different scenarios run, but, in the interest of providing, level playing ground and good information to the investors, I don't know, what additional use the investors would have made of that information.
I think it's just the SEC is kind of challenging to make sure that the company didn't just they did some real work and some real homework around determining what those numbers were, and didn't just kind of pick a value without doing a lot of homework and a lot of detailed analysis. So I think it's more that. I think it's more just kind of testing management to make sure they're doing what they're supposed to be doing.
Yeah, it is interesting when they ask for specific disclosure around things like discount rate, and you really wonder in those circumstances the SEC ever come back and said, no, the discount rate shouldn't have been 30%, it should have been 20%. So again, I think maybe to your point, John, they just want to make sure it's in the range of reasonableness and not wildly off the charts. And for those of you that have ever gone through a business combination, the SX rule that describes how you test for significance can get extremely complicated. For example, if you're a company that's close to or at break even and you're acquiring a company that has big losses, all of a sudden the significance of that acquisition can get huge. And as a result, if you start tripping over the significance threshold test, then suddenly you have to get, maybe not even 1-2 year, but possibly you have to get 3 years of audited financial information for that company. Then you have to disclose pro forma information, which says not only how does that business combination look, let's say it was made in June 30 of this year, you have to present results on a pro forma basis, not just of how it looks for the 6 months this year, but you have to roll back to the last annual audit period that you reported and say, okay, now let's take a look at combining that business with your business for that annual audit period a year ago, put that in your footnotes, and then identify the pro forma adjustments that you made to eliminate perhaps potentially duplicate expenses or non-recurring expenses, and then footnote each of those pro forma adjustments. So there's quite a bit of judgment that has to go into that pro forma presentation and quite a bit of disclosure. So you're going to want to make sure that in an area that has a lot of judgment and also that requires a lot of disclosure, that there's been a fair amount of thought that's gone into the process so that you're adequately responding to the SEC rules.
Yeah, I was just working with one of our clients on the pro forma financials, and it was an issue that the SEC had a number of questions about. I think again, it's just to make sure that the assumptions being made are appropriate, and that they're being disclosed so the investors kind of really understand how those pro forma numbers are coming about, because it can be very difficult. There's a lot of assumptions that go into that, a lot of management judgment. I think the SEC is really just trying to test management and make sure that the management is upfront and clear with the investors about what those judgments are and what those assumptions are, because they really can potentially impact how the business rolls forward and the future impact on the business how those assumptions play out over time. And I think the SEC is really just looking to make sure those things are appropriately disclosed.
And this is just the second half of that comment that really speaks to the pro forma disclosure rules. And again, be aware that the pro forma information that you need to present in the 8K filing, which is due 4 days after the business combination, is significantly different than the pro forma information that you need to include in the footnotes, although it is similar in nature. So you want to make sure that you understand the requirements. And again, this comment is just getting back to the non-recurring pro forma adjustments that you've made. And the SEC is asking for supplemental disclosure around those.
want to spend a few minutes talking about some of the SEC comments around income taxes. Particularly as technology companies expand, we're seeing more and more questions around income taxes, particularly foreign income taxes, is an area where they're focusing a lot more. Some of the areas, income tax valuation, tax provision disclosure. This is an area where I think historically there has not been a lot of commentary by the SEC, but I think because of the complexity of the tax code, and I think, quite honestly, the pressure with a lot of companies having reporting very low effective tax rates, the SEC is really kind of wants to understand that and make sure that the public understands, the investors understand what that's coming from. So you're seeing a lot more comments around the disclosure on income tax provisions, valuation allowances, and whether those are being recorded. For a lot of younger startup companies, the valuation allowances, whether or not the companies will be able to recognize future tax loss carry forwards is very much always in question. And when companies begin to have those valuation allowances or reverse those valuation allowances over time, the SEC wants to make sure that the assumptions and the management is using to make those changes and how they play out are really kind of defined and disclosed. Likewise, you can reinvestment assertions related to liquidity disclosures. Again, it's really kind of the SEC making sure they understand what that's all about. So the SEC is really kind of focused on kind of disaggregating a lot of the income tax provision disclosures, really kind of breaking that information out with detail and determination of the valuation allowances and the sufficiency of the disclosures around those. Likewise, on the valuation allowances, they're really kind of scrutinizing the assessment and realizability of deferred tax assets. There's a lot of judgment in here, and the SEC comments around those. You are seeing a lot more comments from the SEC around those. And so overall, the number of comments in taxes is continuing to increase. See on the next slide here, the number of comments is significantly on the rise over the last couple of years, and I think this is very consistent. As you can see, they've more than doubled in the last three, from 2012 to 2014, which is the last full year we have. And I think that reflects, like I said, the SEC's interest in making sure that the public really understands what's going on in a very, very complex area. And I think, what we've seen is this is a very hard area to explain in English. It tends to get a little bit, short attention by management and very technical. But the SEC is coming back to, they really want to see things in plain English to the extent it can be, and that can be a real challenge in the tax areas to do that. Here's one particular comment related to the registrant had not recognized a valuation allowance against deferred tax assets with the U.S. operating losses. So again, the SEC is really looking to explain the factors that led the company to conclude that it's more likely than not you'll be able to generate taxable income in the future. For a lot of the technology companies that we work with, particularly out here in Silicon Valley, the future realizability of deferred tax assets is always in question, because a lot of companies are really kind of on the early stage of revenue, a lot of times still incurring losses, and how they're going to really kind of turn that around is a real issue. One of the key things is really kind of the timing of when those reversals happen. In this particular case, when the company was going from having a significant valuation allowance to really kind of reversing a lot of that, and the timing is really kind of a big question. If you have a valuation allowance at year end, then you roll into your first or second quarter, and that allowance is either no longer necessary, or the company's concluded it's no longer necessary, or it's been reduced. The SEC is really going to push back and want to understand, what changed, in the business, in the forecast, in management's understanding to really kind of justify that reversal. So anytime that reversal happens, you're going to want to, the SEC is going to want to see and understand what changed to make that happen, and really kind of discuss that. And for management, really to discuss those things, because that timing can be, can be very important. And so that's an area the SEC is really going to focus on, is kind of the timing of, why now and not last quarter or last year.
Yeah, and certainly on this comment, it looks like the company's had 3 consecutive years of pre-tax losses, and typically the rule of thumb that I've seen is 12 quarters of profitability before you would release a valuation allowance against your DTA or against your NOLs. So certainly, unless something dramatically changed in the nature of this business, I think the company's got a lot of explaining to do in this case as to why they would have not reserved for those net operating losses.
Yeah, that's absolutely right. Again, it's a whole timing question. Again, it's management explaining their assumptions, their understanding. That's what the SEC wants to see.
Thanks, John and Matt. And we'll get to our 4th and final polling question. True, false, again. So income tax related comments have increased since 2012. Pretty quick. Is the answer A, true, B, false, or C, not sure? And again, if you're here for CE, you'll have needed to answer 3 of the 4 questions. So if for some reason you missed one earlier in the webinar, make sure you do answer this one. And we'll close the polls here in 3, 2, and 1. And it looks like a good 94% of you were paying attention, John.
Yeah, the answer is, of course, true. Maybe those couple of thought no, that there was a trick question like the last one where it was triple, not double. But this one was pretty straightforward, true or false. And the answer in this case is true. The SEC is looking a lot more at income tax, and we've seen a lot more comments and questions around income taxes. So kind of the last thing we want to talk about here for a few minutes is really kind of some of the best practices about how to respond and what to do when you get an SEC comment letter, because they are obviously, as we've seen in the statistics, they are very common. A significant number of companies do get those comment letters, so it's not it's more likely, it's very likely that you are going to see one before too long. As the SEC, I think they're on a 3-year rotation to try and review every company's financial statements. So if you haven't gotten one the last couple of years, there's a good possibility you're going to get one before too long. So if you do get a comment letter, or when you get a comment letter, it's probably more likely than not that you will before eventually. A couple things you want to do, obviously right off, is you want to understand, kind of read the letter and understand the impact on the financial statements. Is it really just they're looking for a little more disclosure, or are they really challenging the financial statements themselves? I mean, what will the impact be on the financial statements by addressing the comments in the letter? You want to make sure you understand that. Obviously, you want to consult with your legal counsel, because it is very important that you respond completely and quickly to the SEC, certainly within the deadline. The letter always includes a response deadline. And you want to make sure you get back to the SEC. They get really, really cranky if for some reason you don't make that deadline. But I don't know that happens very often, but clearly there is a goal to try and respond as quickly as possible. And so having the counsel involved is very important. You definitely want to consult with your auditors. Chances are they've signed off on the K, if it's a 10K. They would have signed off on a 10K with the audit opinion. Even with the Q, they've done their review. If it's early on, as Matt said, in an S1, then it's more of a back and forth process. But no matter what it is, you want to make sure you're discussing it with your auditors and get their take on it. And as I said, you want to review it and you want to make sure you respond before. And even if the response is just further questions and clarifications, that's absolutely fine. The SEC is very willing to discuss, and I've been on a number of phone calls with the SEC. They'll get on the phone in addition to written responses, and they'll discuss the questions. They'll address management's concern. Generally found them to be very, very reasonable and pretty good business people for the most part to address your concerns.
Yeah, that's one of the things that still continues to surprise me when I deal with folks that are, have been in the public reporting arena or, are getting ready to go public is I would say the reluctance to consult with the SEC. And my experience has always been, and this is going 20 plus years, is that the SEC is always, very willing to respond. They do so in a quick manner. They're very consultative. And they'll tell you, we can do a quick phone call and we can have sort of an informal discussion around this. It's not going to be binding on us, but it's sort of a heads up as to the way that we might lean on this, or if you want to go into a more formal process where you're actually, consulting on a formal basis, you give us all the information and we come back with a formal reply, then that can, be the definitive answer. So I've never really understood companies' reluctance to discuss things with the SEC. To me, it just still continues to baffle me why they are like that. And we just went through a process. One of my companies went through an IPO and established a really good rapport with the SEC examiner by having a number of telephone calls into her. And I think in the end, it really expedited the process just by establishing that familiarity with her. And I think the responses we gave in some circumstances were much less than we might have been led to believe if you had just read the comment and just tried to respond to it without asking for that clarification on the telephone.
Yeah, I think that's been my experience too. Is I think it establishes a lot of credibility for management with the SEC when they get on the phone with the reviewer, the examiner, and have those conversations. As you say, Matt, it does definitely helps clarify how much information they're actually looking for, because sometimes the letter sounds a lot worse than they really intended to be. But I think that it really does help establish a credibility for management and really helps out with the overall process. And if you can establish that rapport, and in my experience, it happens more often than not, you do establish a good rapport with the examiner, as long as management's, timely, open to discussion, kind of has you want to make sure you definitely have your facts, facts to support your position. But if you're open to have that conversation, I agree with you. It's absolutely a great thing to do, and I would highly recommend it, because like more often than not, it helps far more than it hurts.
Yeah. And in consulting with the auditor, again, I think it's my experience has been that sometimes auditors are reluctant to be involved in the comment process, except directly with the client and their attorney. But I'd say press your auditor to participate in those telephone calls with the SEC. There's no restriction or prohibition on doing that, and again, it leads to, I think, just a better answer.
Speaking as the SEC audit lead.
Yes. So again, make sure you know what to include in your response, as we talked about. If something is immaterial, then quantify it for the SEC so that they can agree with you that it is immaterial. Status of your comments, again, often it's in, I'd say certainly when you're going through the S1 process, it's in the company's interest to make sure that you understand how quickly the SEC will respond to your response. So you want to make sure that you know the status. And also if it's something that's going to be complex and require a fair amount of time to research, and certainly I found with the 10K review, the more annual or triennial review process, that the SEC is not in a huge hurry. They'll artificially establish a deadline for you and say, we want you to respond back to us in 30 days. But if the company's going through something, I've never had a circumstance where we have asked for an extension and they have not given it. So if you need more time, if some key people are on vacation, ask for it. And the SEC, I think, almost always replies in a favorable manner.
Yeah, I think sometimes that deadline is really just to make sure that you are responding and that they've kind of got your attention, and you are going to address the issues. My experience has been the same when we've had to go back and ask for more time for various reasons. As long as the reasons are somewhat reasonable. I think the SEC is very good about that, and they're good at they're good about extending the time.
All right. Thank you, gentlemen. So during this webinar, we've covered SEC comments and the comment letter process and key issues, including MD&A, internal controls, cash flow, business combinations, and income tax. And we also just talked about some best practice considerations for everyone to consider. And so we've got a couple of questions that we want to address in the next few minutes before we close up. So take it from there.
One of the questions we got is, do we expect comment letters on XBRL from the SEC soon or ever? I don't know. I'm at your experience. I've not seen a lot of comments or questions on XBRL. I don't know if it's just they haven't gotten to it yet because it's still fairly new and they've got a lot of other things on their plate, and maybe we'll begin to see a lot of that. I suspect that it'll happen if the analysts or people look at the financial statements and using that data start complaining it's inaccurate. But Matt, I don't know about my experience. It has not really happened. I have no idea why or if it'll ever happen, but I don't know what your experience is.
Yeah, I've not seen any comments on XBRL. I was reviewing one publication that said there are over 70,000 unique tags in the taxonomy for XBRL. And just given that sheer volume of numbers, I can't imagine that the SEC it's going to be high on their priority list to try and ensure standardization among 70,000 tagged items. To me, it seems like almost an insurmountable task. And again, I think they've got bigger fish to fry.
Yeah, I think, as I said, unless the SEC starts getting a lot of complaints about the information being inaccurate or incomplete, I don't think you're going to see it.
Yeah. So another one of the questions we got was, how frequently can I expect to be reviewed by the SEC? I believe their intent is that every public company, and they define public company as publicly reporting, but also they have a sort of minimum threshold for number of shareholders that's greater than 500. And I think the intent is for them to review those every 3 years. Again, the depth of that review is going to vary based on the complexity of the company, their view of risk in the marketplace. So I think if it's a small cap company, they're not going to get a huge volume of time and attention from the SEC in terms of a review. And if the company is much larger, then obviously they're going to go through a more deliberate process, and more folks from the Division of Corp Fin are going to be involved in that review.
And I guess the final question we have right now is, how many rounds of questions can I expect to go through? That's kind of a hard one to answer, and I guess it really depends, whether you're talking about an S1 or a 10K. I think typically on a 10K annual filing, usually, I think it's, in my experience, it's really kind of one round. They'll have some questions they'll come back with. They'll look for some additional information. If you respond, if you give them a thorough response, I mean, in my experience, that's usually the end of it. More so on the kind of the 10Ks. And an S1, obviously, it can be a whole lot more. That tends to be a much more iterative process. So I don't know, Matt. What do you think is kind of how many have you seen? You've been involved in a few S1s lately. So how many rounds have you kind of seen?
I think 4 or 5 is probably most common in that arena, and oftentimes because the timing is such that the company is rolling forward and adding another quarter into the document by the time they're responding to the SEC, and so that insert of additional information sometimes causes the SEC to come back with new questions. But I think if you're getting beyond that, you got to question the underwriters and the SEC counsel as to why you're not able to, but I think you can expect to hopefully fully respond in under 4.
Yeah, I mean, if you're doing the S1, I guess the only good news in that is the turnaround of the comments with each round tends to get much quicker.
Yeah.
So while the initial turnaround might be 30 days, as you go down, that period gets down to just eventually a day or 2 comments. So it does get a lot quicker. So I don't want to hold up your registration going effective if they don't need to.
Thank you, John and Matt. So thank you for all the participants for attending. You'll see Matt and John's contact information on the screen. And as well as a reminder for those of you who need CE, you will be receiving an email within 3 business days with access to your certificate if you indeed completed all the necessary requirements. Thank you for attending, and we hope to see you at a future Armino webinar. Thanks so much.
Thank you.